welcome to a new episode of the Insilico Terminal Podcast. My guest today is Stonk Trump and has actually been recommended by the first ever guest on this podcast. Maybe not like the first ever guest, because there are some secret hidden episodes that have never seen the light of day, but the first guest ever of this podcast was Pierre, and that's why I thought I would heed his recommendation and get you on.
Yeah, thank you for having me. I appreciate it.
Yeah, thank you for coming on. Can you maybe like tell me a little bit about yourself? I obviously checked out your Twitter and stuff a bit, and I trust Pierre's recommendation, but I don't know too much about you yet. So you're a trader?
Yeah, so I mainly trade equities and options now, but I got my start in the crypto space. I'm class of 2018.
Mm-hmm.
So started buying Bitcoin back then, and then around 2020 I transitioned mostly full-time to trading options, and so that's what I do now.
How did you first get into trading or into crypto?
You know, I had before 2018 I had done just some sort of passive investing with, just in my buying equity in my brokerage account and those kind of things. But I had been watching, the crypto space, obviously. And, when I saw the big drawdown from the 2017 top, I just kind of figured, man, this has got to be a buying opportunity.
Mm-hmm.
And of course that, led me into the, vicious 2018 hell cycle, but in the end it turned out fine. But at the moment, it was kind of a rude introduction to crypto, but that's kind of how I got started in that space.
What was it like back then? Did you just like start buying Bitcoin spot, other altcoins, or did you get into BitMEX, leverage trading?
No, I never really got into too much leverage, honestly. I mostly just bought on Coinbase, to be honest. I've always been sort of a boring boomer. But, so I that's like in 2018 when I first started buying, that's in the US, that's where you start buying, right? You just start on Coinbase. And so I mostly just started dollar cost averaging into Bitcoin. And then later, through a couple years later, I did get some really good buys in on like Chainlink and different altcoins like that off the COVID lows. So that turned out really well. But in terms of leverage, I've never really messed with leverage too much in the crypto space, other than just buying meme coins and that kind of thing.
Yeah. So you were mostly an investor for that time, and then when did you get more into active trading?
I would say during COVID, when everybody was locked down, and I had a lot more time to look at the screens. I remember in March of 2020 when we were near the COVID lows, and I was watching the S&P 500 chart. I just remember thinking, there's no way they leave this down here. We have elections at the end of the year. Like this has got to go back up into the end of the year. And so it wasn't even really so much of a technical analysis decision. It was just like a gut feeling, I think, that like SPY is way too cheap here, you know? And so I just remember buying like, that was March. I remember buying like, I think it was September or October, 300 SPY calls. And from there, it just, if you were around that time, it just basically went straight up without barely any pullback. So that was kind of my first introduction to options.
You kind of activated a memory of mine that from back then, because during COVID, I don't know if I told this story before or whatever, but like this is kind of how I got into markets, or like how I was first interested, because I was very young at that point, and then I always wanted to like get into stocks, but back then it also wasn't as easy, especially I guess if you weren't in the US. So like I didn't really know how to open a proper brokerage account. I also only just like turned an adult and stuff, and but then all these neo brokers kind of came up, so it became easier. And then I thought like, hey, like this is a really good time. Like I should buy stocks now. This is very scary. I don't really know what is happening, but like they're probably cheap. I should buy them now. but I didn't have an account, so I never ended up doing that. And then I think I made an account in like later that year, so I guess around September is probably when I made my stock account, and I got some money at the time from my grandma that she like just gave to me, and I put it all into this account. And then at first I just like bought random stuff like ETFs and stocks, just some stock picking. And then I found what in Germany there is not like these neo brokers don't have options, but they have something similar. I don't really know what the English translation is. It's something like options paper. I don't really know how it's called, but it's a bit like it's like an option, but like a stupider product. Like options are just better and superior. And obviously I also didn't really understand what I was doing, so I was also on Wall Street Bets at that time. And then through Wall Street Bets, I didn't really like my old job. I was just like on Reddit the whole day, like reading what all these people were doing. And then I was just like, okay, I'm just gonna buy some of these like weird options products of like random things. And then I lost my first couple of thousand for like no real reason. And that was kind of like my introduction to financial markets. Instead of just being smart and buying the COVID bottom because I didn't have the access, I like waited and then burned myself. But I guess it led to where we are now. So how did trading keep going after that for you?
Well, it's been an up and down journey. It's funny you talked about the Wall Street Bets fiasco. Back in 2020, I caught the bottom of AMC. I'm looking at an old post of mine right now. I bought, let's see it was at like $2, and I bought $5 calls. And that was like, that time in 2020 was so ridiculous and so crazy, and I made a lot of money. And then I think in 2022, once we got the, we went into a bear market after that, I gave a bunch back. But since then, I've been able to be, consistently profitable, which is nice.
How did your trading look like? Like, do you just find stocks that seem cheap to you or interesting, and then you like buy longer dated calls? Is that still what you do, or?
Yeah, I'm mostly a dated call trader. I like to watch options flow to give me an idea of where the money is flowing, and then from there I pair that with technical analysis, and if those two things look good together, then that kind of makes a good setup for me.
Actually, another funny side story interjection, because I didn't buy MC, but I bought GameStop. I remember reading the original like Roaring Kitty posts as he like made them back then, and I was like, yeah, this kind of seems like a good idea. So I just like thankfully only bought the normal stock. And then I remember, because it's like okay, I'm not gonna dox myself here, but like it's close to a date for me. So it's like when GameStop happened, I remember at the peak I was like break even on my portfolio with like all the losses that I had from all the other stupid stuff. But of course I was like, nah, I'm not gonna sell here. I'm like gonna wait more. So I did end up making money from that, but I was still like down overall.
That's funny.
Those were very, very funny times, like back when that was really a thing. And then also like the delusions that came afterwards of people just being like mother of all short squeezes, and this subreddit that they made and stuff. And
yeah, they became cult members, man.
Yeah.
The AMC cult is still alive, I'm telling you.
I think the GameStop probably as well.
Probably,
I haven't checked on it in a while, but like the people were really like, like these institutions and the dark pools and all of that stuff is like conspiring against us to not make this go up, but one day it's gonna happen. And I kind of bought into that at the time, a little bit at least, because I didn't really know better. But yeah, it is quite funny looking back in hindsight. So then I guess you had some early success, and then 2022 rolled around with the bear market. How did you handle that?
Yeah, so I'm trying to remember what year. Another big win of mine was silver, and I think that was probably just before 2022, probably 2021, something like that. That was another sort of Reddit GameStop thing where you had the silver squeeze, right? And I think that was 21, maybe January 21, somewhere around there. And I think I made, I think I turned like a $30,000 call position into like 200 grand, right?
Mm-hmm.
And so, you know, that was like a big deal for me at the time. I think that was the biggest win I had ever had. And, you know, I went and bought a new car and like, you know, did all this stuff. And then, you know, I hadn't really gotten familiar at the time with like the way like capital gains taxes work and, you know, all those things like, hey, all this money I made this year, I got to make sure next year I'm going to have to pay taxes on this. So I think during the 2022 bear market, I did give some back for sure.
Yeah.
But one thing I learned during 2022 was to like follow the market internals a little deeper. So I started looking at like institutional positioning and paying attention to like when big institutions get to like max short levels or max long levels. And that really helped me to sort of gauge the market in a bit of a more, I guess, healthy way where I had a better risk tolerance and a better understanding of risk and where things were at sort of in the plumbing of the market. And I know like in 2022, around the lows, a lot of those signals started to line up. And then of course we saw 2023, you know, took off and left. And, you know, in 2020, it was just another like good lesson of mine in terms of market psychology, because in 2022, if you're around, everybody thought we're going lower and we're going into a recession. Like that was any analyst you talked to, any bank paper you read, everything was saying we're going lower, we're going into a recession. And because of that, I mean, that's when you get sentiment in the toilet. You know, you get everybody short, everybody max bearish, and that's when you have the best setups for squeezes and long entries. So that was something that sort of added to my repertoire of trading tools, so to speak, and that's helped me a lot since to try to stay on the right side of things.
Were you already full-time into trading at that point?
Well, I've done real estate investing, which has always given me some passive income. So I was maybe not completely full-time, but giving it a good amount of time for sure at that point.
I see. Do you think that's something that helped you just to be more in tune with the market, like being there, having more time to really get into it, opposed to someone that has like a full-time career apart from that?
Yeah, I mean, I think there's no substitute for screen time. You know, I think that the more time you like just spend in the market watching how the market moves, you sort of get an intuition to what they do. You know, like for example, like all the classic, you know, stop runs where they go to a big level that a lot of traders would think is support, and they break through that level and cause people to panic and then reclaim it and send it from there. Like that's easy to say on paper, but like if you haven't watched that play out over and over and over again, you know, with your own eyes, then it can be a lot more emotional at the time. But after a while, you start getting used to like, oh yeah, this is how this works. This is what they're gonna do. You know.
What sort of data points do you look at, or like what do you use to gauge institutional positioning and stuff like that? Since our listeners are mostly crypto people, and I think at least from I don't really look too much at TradFi stuff, so I think the data is kind of different.
Well, there's several different you know, ways to access it. I have a Zero Hedge subscription, which allows me to look at all the different weekly updates from the investment banks. So like weekly, I'll read like Goldman Sachs, Deutsche Bank, you know, JPM, all these different people. They put out updates every week that show what the positioning is looking like for different cohorts of the market. So you have, like, for example, systematic funds, which are the non-emotional algo-based trend following funds that just buy.
This is the CTAs, right?
CTAs, yes.
Yeah,
they just
okay.
buy based on rules, right? If it breaks this level, I sell. If it reclaims this level, I buy. It's simply rule-based trend following script. And then you have also discretionary investors, which would be like your hedge funds, people sitting behind a desk pressing buttons. You have vol control funds, people that buy based on what the VIX is doing. So you have many different cohorts in the market that all have like historical ranges in their positioning, right? Just like you would look at, say, a range on Bitcoin or a range on the S&P 500, where when it gets to the top of the range, that's normally around where it tops, etc. You have these same type of ranges in institutional positioning. So, historically, when CTAs are max short, that means they don't have any more selling to do. That means that if the market continues down, they're likely going to do some buying because they're already max short. You know? So those kind of parameters sort of give you a sneak peek into what's going on behind the market and what really moves the market with these different players that are buying and selling with size. And it's not always super useful. Sometimes it's just noise, but it becomes very useful at the extremes.
Yeah. It actually makes a lot of sense. So you don't really have to properly understand, like, hey, what are all these institutions like particularly doing in their strategy? What are they thinking? But just like looking at when their positioning becomes very extreme to like whatever side, then there's a time to pay attention at least. Right.
And I think it's a lot easier to spot on bottoms because bottoms happen quicker. Tops are more of a process. So, maybe rather than a short signal, it might be more of a go cash signal or be cautious or reduce risk signal at the top. But at the bottom, a lot of times, if you look at the V recoveries we got, off the tariff lows in April, and then again off the Iran lows in March, April of this year, they both had extreme short side positioning, and so when you get that extreme on the short side, that's when you get violent snapbacks.
Can you maybe like walk us through an example of a trade that you maybe like have taken recently or whatever? Like what kind of data did you look at first, and then how do you go about putting it on, sizing, executing?
Well, let's just take, for example, the March lows with all the Iran fear and everything that was going on there. I think part of being a good trader is learning to ignore the noise, right? Because whenever there's a major low in the market, the low happens first before all the bad news finishes. Like the market is forward looking. So anytime if you're expecting, I need to wait out this Iran conflict, for example, to figure out, if I'm going to buy anything, I want to be safe. I don't, there's too much news hitting right now. It's all negative. I got to wait this out. If you think like that, then you're going to miss your entry. If you're looking for, optimal swing entries. And so it's always noisy at a bottom. The news is always the worst. In fact, when it's the worst is normally when you see a turnaround in the market, because at that point, the market's priced it in already and it's ready to move on to an optimism outlook. So the first thing, when it comes to major swing entries for me, especially probably in TradFi more than crypto, just because the news is so much more prevalent in equities, is to sort of tune out the noise. Like, okay, so the Iran may have been the reason we entered this correction. But beyond that, there's really no need to constantly be watching the news channel unless you're just, scalping off on the 5 minute off of news candles.
Yeah.
But once we start getting into that correction and everything's noisy and everything's loud, that's like what I said earlier, to start looking at what is positioning actually telling me, like what is happening here. Because once we get to a level of, max short, to me, that kind of says we're going to have a floor somewhere around here. Now, you may not always catch the exact bottom, but if you can sort of assess, listen, I think the selling is mostly done, then that's where you can sort of discern that a floor is here or pretty close. So when we get to that kind of environment, that's when I want to start. First of all, I want to start paying a lot of attention to the options flow to see if I'm seeing any big put selling on the indexes, or any big buying in, certain individual names. And for me, I like to start averaging in to dated calls. So, give myself, if I'm looking at this as a swing entry, I want to give myself at least, 3-4 months till expiry or longer, depending on what your risk preference is. And just start building a position around that floor.
Do you just go long calls by themselves? I think it's called naked calls, is it?
Yeah,
Do
mostly.
you do call spreads or?
Not often, just because I just try to keep things simple. I mean, for me, I don't claim to be, a market whiz by any means. I don't claim to be the smartest person on the earth when it comes to markets, but, I just try to think, listen, if I think something's going to go up, I'm going to pick an expiry that makes sense to me. And in some ways, an option is just like a leveraged position in crypto. It's just giving you a little bit more juice to the long entry that you think is good.
Do you ever buy puts, or you just don't really play the downside and just go to cash?
I do, but I try to be, I would say, 80 to 90% long only, just because I think that's more advantageous the way the stock market works.
Yeah, that makes sense.
I mean, if you just look at long-term charts, it goes up and to the right. And so while you can get paid pretty well off puts, in my experience, you often got to sit underwater for a while, or, they make entries really hard. And so sometimes I've played puts and gotten paid well. Sometimes I'll use them as a hedge. If I have a pretty good long exposure, I'll buy puts as a hedge just to protect me from downside a little bit. But ultimately, I think longs is where you get paid in the stock market.
Do you mostly focus on indices, or do you also play single name stocks?
Both. Individual name stocks are kind of more my day-to-day trades. I like to play indices on big swing points, like major entries where I think, okay, this is a yearly bottom type of entry, like we had off the tariff lows or off these Iran lows. I think then it makes sense to play indexes, but individual names are really where you can outperform the indexes. You have to be a little bit more selective, but I mean, you just look at what the semiconductors did this year. If you bought semiconductors, in April, you outperformed the indexes by multiples, so there's always alpha in individual names for sure.
How do you go about asset selection then in individual stocks? And there's tons and tons and tons of stocks. How do you know what to look at?
For me, I look at the options flow, and I use the options flow pretty much like I would a scanner. So I scan through the flow on a daily basis, and when I see different names that I think have good flow and have good charts, then I'll add those to my watch list. And, I have, tons of different watch lists that are just all based on flow that's come in either over the past week or month or however long.
Mm-hmm.
And so that helps me because the stock market is endless. I mean, there's so many names. How could you ever know, So
Yeah.
I need something to help me distinguish what's the right name to be paying attention to. Even if I don't end up taking the trade, at least it helps me to pull that ticker up on my, on my screen and at least take a look at it. Whereas if I hadn't seen the flow, I might not have even ever known that stock existed,
Mm-hmm. How do you structure your portfolio kind of, I guess? Because it seems a bit different from how you do crypto stuff. Mostly because you use options, so
Mm-hmm.
for the one part you can only really you lose your premium and not
Right.
the whole leverage position in your whole account. And then also I guess there is a lot of I'm actually not sure how that plays out in real life, but I would assume there's a lot of correlation, especially to the long, if you just play trend following long side stuff. How do you manage your risk there?
Well, I think you just have to. The first thing is you manage risk through your expiry date, right? So I don't play short-term options just because it's way too volatile.
Mm-hmm.
So if you're buying options with time on them that don't expire for a few months or don't expire for a year, your downside risk is much less.
Yeah.
And so it's easier to have a defined stop level on the chart. And hey, if that stop level is hit, maybe my option's going to be down, 10, 15%.
Mm-hmm.
Not the end of the world, right? But if I happen to catch a really good swing entry, even though those options are 6 months out, in a few weeks, they could be up 100%, if I caught the entry right. So that's the first thing, is just making sure that you give yourself time. Other than that is just sizing in appropriately according to that risk. The shorter the shorter the expiry, the less size you should put in. The longer the expiry, the more comfortable I am putting some size in. And for me, what's helped me a lot is just taking profit along the way at intervals based on premium increase rather than intervals just on the chart.
Mm-hmm.
Because options move so fast that I want to be able to capture that profit as I see it. So oftentimes, if I'm looking for a move that will take the options up, say 100%, a A to B move on the chart, maybe
Mm-hmm.
it would give me 100% premium increase on my options. I'm taking profit along the way at 30%, 50%, 70%, 100%, rather than waiting all the way until I reach the final TP. And the reason I do that is that that's a way of, as you're doing that, you're de-risking, right?
Mm-hmm.
So even if you have your directional assumption correct, depending on how fast you get to that take profit point or how choppy it is along the way, your option premium can go back to zero, or not zero, but go back to break even. So to me, it makes a lot of sense to take profit along the way at different intervals, and that's helped me to compound those gains along the way. So, and it helps me to have far less round trips, which is very common in the options world,
Mm-hmm.
And a lot of times you might get a round trip, and if you look back, you cut it at break even, and if you look back in 2-3 weeks, it turns out that the trade worked, right?
Yeah.
But because you still had full size on, you're just going to cut it when it gets back to break even and not let it, sit around there. But if you had already taken healthy trims at, say, 30%, 50%, and you were now in half of what you had originally, now you might let it sit around at break even for a little while and see what happens, So you're able to de-risk that way, and also you're able to kind of compound gains within your portfolio, because for me, like, options are not really a long-term investing tool. I mean, they can be if you buy like leaps, for example, like options that don't expire for a year out or whatever. But for me, when I see 50%, 100% gain, I'm going to take that money. So a lot of times, even if I think this is a great swing trade setup, once I see that 100% gain, I mean, I'm out, Yeah. And so that creates a compounding effect in your portfolio where, you kind of have to keep rotating in and out of things. And so that's where the flow helps, is finding new names, finding out where money is rotating to, because you're maybe not just going to be sitting in one thing for 6 months like you would if you played equities or, spot crypto. You kind of, out of necessity of taking the money while it's in front of you, you have to take it at different profit intervals and then look for the next trade,
Do you give yourself kind of like a time expiry as well? Like if it gets too close to the options expiry itself, would you consider rolling the options contract over, or you just like, this hasn't played out now, so I'm out of the position?
Well, I normally don't really want to get too close to expiry on my options, just because, I'm not really concerned with, is the price going to be at my target by expiration? I'm more concerned with what is the premium increase from when I bought it, right? So, if, for example, if I bought something today and it doesn't expire till October, I'm looking to probably be out of that option, or at least most of it, down to runners by September sometime. If I have a good entry, it shouldn't take forever, and because the closer you get to your expiration date, options have something called theta, which works against you, which means for every day you get closer to your expiration date, your option goes down a little bit. So if you're in calls that have lots of time, the theta doesn't really matter that much because it's only going down a tiny bit. But if you're in weeklies, every day that goes by, that theta's attacking your option premiums a lot. And so to me, you never really want to get too close to your expiration date. You always want to have, some time left before you get out. The only time I would let something run all the way into expiration is if I was like down to runners, or a moon bag, as they would say in crypto, where I've already taken my money out and I'm like, hey, let's see what this thing can do in the next month,
What's the reason that you've never ventured more into crypto as a whole, since that's kind of like where you started, and also what this podcast is mostly about? Why you're not why are you only focused on TradFi and options and not slinging perps in the order books?
I mean, for me, I spend so much time and so much of my mental capital in trying to understand this market that it just seems like, I kind of have to give myself a realistic expectation of how much I can handle, and if I'm doing one thing well, sometimes I don't want to confuse myself by adding more, and, it's kind of nice to have my weekends off. It's kind of nice for the market to be over at 4:00.
Yeah, I can
and I can kind of structure my day regularly around that. Also crypto is just, I mean, I think I'm a pretty tech savvy person, but I'm also, not, maybe not as tech savvy as some others. And crypto has a lot of complexity to it, there's always new things you need to learn, new exchanges, new methods, so, and then, taxes are very complicated, and, I spent a few years, pulling my hair out, trying to figure out how I was going to file crypto taxes for 1,000, phantom transactions or whatever.
Oh God, yeah.
And it's like, TradFi is just simpler. It's something I've come to understand. And also they're now there's now options for being able to play crypto via TradFi, right? So in my broker now, I can buy calls on Bitcoin ETFs. I can buy Solana ETFs. I can buy. There's an ETF now that is related to hype. There's Ethereum ETFs. There's all these kind of, and then there's a number of different crypto related stocks like MicroStrategy or some of the Bitcoin mining stocks. So there's ways to get exposure to crypto still within the TradFi space and not have to take money out of my brokerage and put it on chain,
It's actually quite interesting to hear these things from like the other side, like the other's perspective, because most of the people that I talk to and most of the people in crypto are kind of like, and me personally as well, we're like, hey, I already have all my money on chain and it's great that we finally have an option to like have it stay that way, but we can also access the TradFi products. But it's kind of cool that there's also the other perspective of like people that are only playing TradFi, that they also have way more access to crypto products without having to like bother with all the on-chain stuff and everything that we're doing.
Yeah, I mean, it's just a different world, man. I mean, and I think it's just what you feel more comfortable with, I had a really good run on meme coins in, 2023 when Bowden went to $1. I mean, I made a lot of money on that coin and I had a lot of fun, it was hilarious. And it was such a fun time in the meme coin space. But at the same time, when you have a large position in a meme coin, like it's not easy to get out, and then on top of that, you have, everybody watching your wallet and, and giving you problems and all this stuff. And it's just like, that's a very nuanced sort of complex trading atmosphere where you have to like really know how to go about things, when you're on chain. I mean, you got to make sure your security protocols are perfect. You got to make sure that you're not clicking any weird links. You got to make sure that you're, using the right, whether you're DCA buying or whatever through, different platforms, or whether you're full stack Hitlering or whatever you're doing, you have to have a strategy, right? Like that's very specific to that environment of on chain. And to me, that is like constantly changing and evolving. I mean, I haven't really done much on chain since 2023, 24. I'm sure if I wanted to go back now and, deposit a huge amount, I'd have a learning curve just in the last 2 years of what has changed, what's the new exchanges, what's the new trending coins or whatever. And so for me, just trading within my stock brokerage is just a much more simpler, sort of predictable way to go about things.
I just forgot what I wanted to ask, actually. No, I have a good question. So, since you're mostly into stocks and TradFi, what do you think is something that people that mostly trade crypto, or like what are some of the things that people can learn from you if they mostly trade crypto? What are like crypto traders kind of missing, or like what could they add to their repertoire?
Well, I mean, I think there's, with so many TradFi perps available to crypto traders now, I don't think there's any reason that crypto traders shouldn't be following what's happening in the equity markets. Especially when you have, I'm sort of cycle pilled when it comes to crypto. I kind of believe in the 4-year cycle and think we're kind of in that part of the market right now where it's just going to be like annoying chop, and obviously if you play all kind of different altcoins and things, there's always opportunity somewhere. But on the grand scheme of things, in a high time frame perspective, if you have a situation where Bitcoin's going to be chopping around until October maybe, why not follow TradFi markets and see if you can catch some opportunities in some markets that are really moving,
Are there any other like particularities that you think people in crypto could learn more from, or like just the way that they approach markets, not just in what they look like, but or what they look at, but also in like the way that people trade markets. Like the crypto people are very short-term oriented compared to what you have described so far.
Well, I think crypto traders actually can have an edge in TradFi markets because you're used to so much volatility. Like crypto markets have so much volatility and there's so many sweeps of liquidity. And, if you've trained yourself to be comfortable in those markets, to not, feel like puking when, they're sweeping the lows and being able to buy those kind of deviations and those kind of things, I think that kind of experience can really translate well into traditional finance markets because, especially now in these times, a lot of these stocks are moving more like a crypto would. If you look at some of these semiconductor stocks, they're up, 10% one day and down 15% the next day.
Yeah.
They have these wild swings. And I think that type of volatility is something that crypto traders are more comfortable with and have sort of trained themselves on. So I actually think that they can have an edge where, they might be buying when a lot of traditional finance guys are, puking up their longs at the lows,
Yeah. The volatility has kind of become a little bit less nowadays, especially like in the bear market and stuff when there isn't that much interest.
Yeah.
But I remember we always had like these memes of when there was a 3% down day in TradFi on the S&P or whatever, there's already like a catastrophe and people are screaming for like recession and whatever, and we're like, oh, until it's like -10, we don't really pay too much attention.
Yeah, it's like
the normal Tuesday.
It's like the first time.
Yeah, exactly.
Meme, right? Yeah.
Yeah, I think crypto traders can definitely like are a lot more able to stomach the volatility that has been more common recently in TradFi as well.
Yeah, for sure. And I think that sharpens your TA skills, right? Because, you're forced into, being a bit more disciplined on your entries. And so I think that can definitely translate to the stock market for sure.
Do you have any views on where we are in the market right now? Like, do you take stuff like macro and narratives and all of that into account?
Yeah, so I mean, we're in an interesting place right now because a lot of people would say we're in a bubble, but you also have robust earnings growth that's supporting that bubble, right? So for me, the way I look at it, to keep things simple, is that I think a new bull market or a new bull trend started off of the Iran lows in March and April. And so I try to look at things through that lens. We had a major correction off the tariff lows. That was a 20% correction. Then we had this digestion into the Iran lows that was, I don't know, I think it was maybe, I'd have to pull up the chart, but it's probably 10 to 13% correction or something like that. Right where we are now is sort of the first major correction that we're getting off of those Iran lows. So although there's been a lot of heat in the semiconductor space, like if you look at what's getting all the bear porn nowadays is in the semiconductor space, right? Because you have a lot of these semiconductor individual names down 50% off the highs. I think SMH, which is like the semiconductor ETF, is down 20% off the highs. So technically in a bear market if it doesn't recover here, right? But if you look at like the S&P 500, it's just sort of consolidating after a nice run up.
Yeah.
It's sort of just consolidating around its moving averages. It's sort of like a perfect picture of consolidation if you were to draw it, right? And so I always try to give the benefit of the doubt to the bulls just because of the way our markets work in TradFi. And I think that, while AI could be a bubble, quote unquote, I think it still has a lot of room to go. And I don't know exactly what that looks like in terms of the path of the chart, but I think it makes more sense to continue to look for bullish opportunities within that general perspective that, this is a technology revolution that we're undergoing right now. And you have to just sort of see that, this has a lot of bullish potential. Now, with that being said, it's important to choose your entries within that bullish potential, because, even if you look at charts of past bubbles that went up, 500% or whatever it might be, there's always brutal corrections and dips within that system, right? So, I think it's important to sort of recognize where we're at. I don't think that we're necessarily done. I don't think we're at a major top here. But like, for example, the S&P is up. It went up 20% from the lows. So that's probably your easy money right there that's already been made, right? So now you have this consolidation we're going through. It's going to make things a little bit more difficult. It's going to make things a little bit more challenging. And so, but at some point, I think it'll start to trend again. So I'm more of the mindset to just continue to look for opportunities, maybe de-risk some now that I know this, this easy money has been made. But I don't think that we're at a major top here at all. I think that we have some room to run still, perhaps into the fall. Normally we always get a correction of some kind into like October in TradFi. So I think that correction will tell us a lot about if this bubble is over or if it's popped, because, if we get, a decent correction in October, but something that's not catastrophic, and that October correction can present a brand new buying opportunity, and maybe we get some of those institutional signals that we like to look at where everyone's getting max short into October and the news is really bad and the sky is falling, then maybe that'll set up for another big run, into the end of the year. So I think it makes sense for me to just lean bullish and to just be wise with entries, but to look for a continuation of the trend when it comes.
Do you have any concerns more short term when it comes to like the Iran war flaring up again, and also we're recording this like one day before the FOMC meeting tomorrow, and people are talking about surprise hikes and stuff like that?
Well, listen, I mean, systematic risk exists, right? I mean, as a trader, you're never going to be in a market without risk. I personally don't think Walsh is going to hike tomorrow. I don't think we're there yet. I think the 30% odds of a hike are a bit high. The Iran war, I'm really not too concerned with, just because to me, the market has priced it in already. I mean, the lows that we were in the end of March, that was the market pricing in the Iran war, and we're since 20% off those lows. So to me, I mean, and you even look at some of the recent headlines. I mean, just look at a chart of the S&P 500. It's in a it's in like a 3-4% range. So how much have these Iran headlines really moved the needle? Not much. So to me, that I think the market has sort of familiarized itself with that conflict now. I mean, actually, traditionally, war is bullish. War stimulates spending and all these other things. So I'm not really too concerned about that. What I get more concerned about is when I start seeing positioning max long. That's when I start getting uncomfortable. Not when people are saying there's risk, there's problems, we're worried. That's not when I get concerned. I get concerned when everyone is saying this market is going to keep going up forever, and there's no sense in buying puts, and and you have
kind of what we had a few weeks ago with like memory and stuff, especially when it just seemed
that's a very good point. I mean, if you look at the memory space, that is a very good example of institutional positioning being overheated. Because let me see if I can pull it up on my Twitter. I had a good post about that. The semiconductor trade was the most crowded trade in the history of crowded trades.
Really, that's great.
Let me see if I can find it here. So, they have, studies that follow what the most crowded trades are. So this was June 17th. I was looking at this data, and if we look at the SMH chart, SMH, which is a semiconductor ETF, topped on June 22nd. So on June 17th, I was looking at some data from Bank of America. The latest fund manager survey from Bank of America found that semiconductors are the most crowded trade since the survey started.
Oh, wow.
And looking at a graph, this went all the way back to like October of 2014. And it shows all the other crowded trades over the years. So like you had like long US dollar, you had, long NASDAQ, long tech, long oil. Just recently, you had long gold, when that was going parabolic. And long semis was more crowded than every single one of those trades since October 2014. And so what you get when you have a scenario like that is it doesn't matter how good the earnings are. And I think that's something that a lot of people in the long memory camp didn't understand. They're like, this doesn't make any sense. How is this down 10% off the highs when the earnings are so good? The earnings continue to go up. They're making new deals. How is this happening? It's because everybody that wants to own this stock already owns it. I mean, you have institutions, hedge funds, things like that. They have rules as to how much of a particular asset they can own, right? They can't have 100% of their book in one stock.
Who is left to buy?
So who's left to buy? I mean, retail's already in, for the last 2 months buying these stocks. And so you get to a point where regardless of their earnings, regardless of how bullish the story is, they've just flown too close to the sun. And when you start unwinding those kind of trades, you get the action that we see, today, where that's now down 20% off the highs in, a few weeks. And the reason being is that everybody has to get out, right? It becomes sort of a snowball effect where the lower it goes, the more selling you get because institutions are scrambling for the exits. And so, that's the type of thing that gets me nervous in terms of, well, are we getting to a place where this is not sustainable? It's not, worries about the Fed, worries about the war. It's what is positioning saying? How far into this trade are people? Now, the interesting thing about this whole semis trade is that, while semis were extremely crowded, some of the other areas of the market were not crowded at all. And so you had an opportunity for rotation. And that's why if you look at some other places in the market like financials or biotech, some of these other areas, you can look and see like when semis topped, some of these other areas in the market were just shot out of a cannon because people didn't want to exit the market. It's a bull market. They just want to get in something that they're not concerned about. And so you get rotation where money is coming out of this most crowded trade ever and it's diversifying into other areas of the market. And that's what happens in a healthy bull market trend, is that even though some of these areas are topping, other areas are now catching up. And so that's sort of the most bullish scenario when you have these overheated areas, is that hopefully that spillover to the broader indexes can be contained because there's rotation under the hood.
While we were already talking about rotation, I want to ask one last question.
Sure.
Which, most people will probably care about the most here, since we're all crypto people, and you've already painted a good picture for the foreseeable future about stocks and all of that stuff. But crypto isn't doing so well right now, and maybe you're not a crypto focused trader, but you're still a spot holder or ex-spot holder. Mm-hmm. What do you think about Bitcoin here, or like crypto in particular? Where do you see it going?
Well, I'm excited to start looking for opportunities to build crypto positions into the fall. I just think that we're sort of in Goblin Town chop mode right now. You know, I mean, if you look at the Bitcoin chart, we're sort of in this 15% range right now off the lows. And there's been some constructive signs. I mean, it's looked good here for a little while, and then it's sort of starting to come back down. I think that we can kind of continue to chop around this area. The one thing that concerns me about getting long, swing long with significant size in crypto-related stuff right now is that if equities have a big pullback into October, I just don't know that crypto has a strength to decouple from that.
Yeah.
And so when you have that sort of looming on the horizon, where let's say the S&P breaks out and goes up another 10% between now and September, now you're in a place in equity land where many things are probably getting overheated, and you're probably due for a significant pullback into that bearish seasonality window of September, October. Mm-hmm. And if Bitcoin has been sort of just ranging and maybe started peeking its head out of that range around that same time, do we really expect that crypto can fully decouple from equities if we get, a nasty pullback into the fall? Yeah. That's just, that risk there to me is just sort of too much to stomach for anything more than short-term trades at the moment. Yeah. But I do think that from a spot buyer's perspective, starting to dollar cost average from now until, say, November probably turns out pretty well. Mm-hmm. I don't think Bitcoin's over. I think that Bitcoin is going to have institutional demand again. We just kind of have to let the cycle play out, and be smart about how much we're dipping our toes into the pool right now.
I think that's a good balanced take, a good take to end it on some hopium, not too much doom. Thank you very much for coming on, unless you have anything else that you wanted to mention. Or
No, thank you for having me. It's been a pleasure. I really appreciate it.
Same. So I hope everyone enjoyed this discussion, and thank you everyone for listening.